So what's the best stock to buy right now? I often get this question during my live webinar because it's really difficult to invest in an overvalued market, especially if you don't have an investment process. A few days ago, I had to ask myself that very same question because I had $10,000 to invest in my retirement account. So today, I'm going to walk you through my investment process. I'm going to show you how I make the identification of great candidate and, of course, what I decided to purchase with that $10,000. So we're going to look at the key financial metrics to make a great buy list. We're going to look at how to analyze a company business model. We're also going to focus on the dividend metrics. And finally, we're going to conclude with the investment thesis, the most important part of your investment process. So let's start with the key financial metrics to identify for great candidates. Dividend Stocks Rock members know that I am a big fan of the dividend triangle. This is the foundation of my stock research that I created for myself, focusing on companies with great revenue growth, great earnings growth, and also great dividend growth. The key point here is to identify companies like in this example will show constant ways to increase their sales either by organic growth or by acquisition. Then they must also show that they are profitable. So on top of growing revenue, I want to see growing earnings per share. In this example, we can see that as the revenue grows, the earnings per share follows. This is a great foundation for a solid business where revenue increases, profit increases, and therefore the dividend will follow. So those key metrics of the dividend triangle will provide me with a great list of companies with strong fundamentals and that have been thriving over the past 5 years. It increased my level of conviction, it makes my selection easier, and the point at this level is to really have a wide range of selection from all sectors. To create that list, I have used the DSR stock screener, but I'm going to show you how you can do it on your own later on in this video. But for now, what I wanted for my portfolio at this stage is to narrow it down to the industrial sector. I wanted to benefit from massive investment from both the US and the Canadian government into infrastructure, so I was looking for an infrastructure play. So I started with my rockstar list and then I narrow it down into the industrial sector and then one step further into everything that is related to engineering firms and construction firms. And then I found Stantec, ticker STN or EN.TO because that company trades on both financial markets on the US and on the Canadian side. So Stantec is an engineering firm covering everything from the start of a project till the construction, the management, the decommissioning, and also how you can get rid of that infrastructure. I really like that they move through the entire cycle so it can help clients to deal with old infrastructure that they have currently, plan for a new one, and also how to recycle what's going on with their old infrastructure that is no more use. Once you find a company, it's really important to understand its business model. So for Stantec, on top of being an engineering firm, I need to know in which kind of field are they active. As you can see, you're going to find a lot of information in the investor's presentation that will teach you what's the business model look like. So for this one, we're really talking about a major play on the infrastructure, on water services, environmental services, energy and resources, and also building. So they are able to go for 5 business units and they are also present across the world. So the most of their engineers still work in North America, but they have a strong presence in Europe and also in Australia. As I was trying to understand the company's business model and vision, I got this chart telling me what they wanted to do between 2023 and 2026. I like to look at the short-term and the long-term vision for a company, so it tells me if they envision if the dividend triangle will continue to grow or not. Well, in this case, they expect high single-digit revenue growth rate. They have a very solid balance sheet that we're going to take a look at in this moment, and also strong earnings potential. So the 3 years financial targets was really in line with what I believed in, and also looking at the long-term vision with a combination of organic growth and acquisition to double their net revenue. So overall, this company seems to be on a very positive track, surfing on many tailwinds. But at this stage, I still don't know what it is, so I still need to identify what the growth vectors are. Since Stantec has a lot of different business units, they are able to work on several different growth vectors. The first one is the water security. We all know that water management has become a major theme for many municipalities across North America, and Stantec is providing solutions for those. So I'm thinking, well, demand for this business unit will continue to grow. The fact that the infrastructure is aging, and that was like exactly at the center of my investment process when I was looking for a new company, well, Stantec is very well positioned to offer solutions as well. They also try to help clients build future technology and advanced manufacturing. They also support data centers construction. So that is also going to be an interesting play considering that AI is rising. Finally, all the technologies to be used to adapt urbanization to climate change will also be a very important challenge in the futures for the government. And Stantec is also well positioned with a lot of experience and a lot of services that they can provide to their customers. On top of surfing on a lot of tailwinds, what I like about this business is the fact that they can offer multiple services to the same client. So it opens the door to multiple cross-selling opportunities. Their top 25 clients have been in business with them for over 20 years, and they use more than one business unit. So it tells me that whenever they make an acquisition, they have this ability to offer their portfolio of service to their new portfolio of clients, and also with that acquisition, they acquire more services that they can go back to their existing portfolio of client and offer even more services. So the cross-selling opportunities in this kind of business is huge, especially considering that the engineering market is highly fragmented. So all those growth vectors seem super nice, but it's always good to back up your thesis and your narrative with some good numbers, right? So one thing that is super important when you're looking at construction firm or engineering firm is their backlog. In this case, you can see that the backlog has increased by 13% over the past 12 months, and it seems to be very stable, a very growth trend over there because they have a lot of tailwinds. So unfortunately, no businesses are perfect. Business models are not protected against all risk, and we have to talk about the potential downsides. So we have identified what the business is doing with understanding their business model. We have also created a great narrative around the growth vectors. Now it's time to talk about what could go wrong. So the first thing is when you look at the long-term trend for their revenue, this Stantec will tell you a big story here. So you will see that in 2010, in 2018, and in 2022, we see revenue going down. That business model is quite cyclical. When there's an economic slowdown, a recession, some concerns, higher interest rate, it is difficult for those type of businesses to ink more contracts and to benefit from more capex that is being invested throughout infrastructure. Therefore, you see the revenue falling, earnings could fall also, and eventually that could also affect the dividend. Over the past 10 years, that has not been a concern because the company managed their balance sheet in a very good way, but still you have to consider this, that it's not going to be an easy ride if you invest in an engineering firm. The second potential risk, and it's a very big one, is the competition. So competition is huge there. We can take the example of WSP Global, another engineering firm that has roughly double the revenue size of Stantec. So what does it mean? Well, it means that it's going to be very hard to fight for the retention of their talent. So engineers are at the center of those companies, and maybe they have greater ambition and they will want to work for a larger engineering firm such as WSP Global. The second thing that it will happen is a lot of competition to get next contracts. So there could be a bidding war to bid lower, affect margins, and it could lead to a lot of weaker contract down the road. Another risk is Stantec shows a combination of organic growth but also growth by acquisitions. So yes, the engineering firms are a highly fragmented market. There are plenty of opportunity to buy, but maybe you're going to make the wrong acquisition. Maybe you're going to overpay. Maybe you're going to have difficulties into integrating it, or you're going to get into a bidding war with WSP Global that used the exact same playbook to grow their business. So there's a lot of fights to come up, and and it's going to be difficult to always replicate the same growth model that we have seen in the past 5 years. The last risk that I see, and definitely it's not the smallest one, is the valuation. I'm not a big fan of valuation methodologies in general because your assumptions are as good as mine, but I like to look at the overall trend for the PE ratio versus the current PE ratio. It tells me how the market is used to pay a multiple of earnings over time, assuming that we have a similar business model in a similar environment. So what we can see here on this graph is the average PE ratio is around 29 times the earnings over the past 10 years, while the company is currently trading at 35, almost 36 times the earnings. It seems a bit steep, but the forward PE ratio is down to 23 times the earnings. So overall, I'm not getting a great deal by buying Stantec at this point, but the reason why I invest in this one is because it shows incredibly strong financial metrics, and on top of that, there is a very strong investment thesis. So before we move to the dividend metric and the conclusion of what is my investment thesis, I want you to help you find those kind of businesses. I've created the Rockstar list from the Dividend Stocks Rock Stock Screener to help you out in your search for the potential candidate. So the Rockstar list is only a small portion of what the DSR Stock Screener can offer you, but it's a great shortcut if you want to identify companies with a strong dividend triangle. So the Rockstar list only includes companies with a positive revenue growth, earnings growth, and dividend growth over the past 5 years, and a Chowder score of at least 8. So that includes the current yield plus the average of the past 5 dividend growth rate. And if it's under 8, it's not going to be part of the Rockstar list. So once you have that list of strong dividend growers, you can narrow down your research by focusing on the top growers and narrow it down into specific sectors to make sure that you do not make any duplicate in your portfolio. So you can go at dividendstocksrock.com/rockstar to download your Rockstar list. You just have to put your email there. You're going to receive it by email. And if you're already a DSR members, well, actually, we tell you how to build an even more precise Rockstar list in the DSR fundamentals. So of course, you get the best out of it, but I wanted to provide a free version of the Rockstar list to all YouTube viewers. So with the Rockstar list, you're going to be able to find great companies to dive into. And once you have found what the business model looked like, what are the growth vectors and the potential risk, well, it's fun to have a great story, but it's also more important to have it backed by solid numbers. So going back to my dividend triangle for Stantec, what I want to see here is the trend. So I can see that between 2017 and 2021, 2022, small increase for the revenue, but nothing like crazy. But then starting in 22, we see that the revenue goes up very quickly. We have again a combination of organic growth and also growth by acquisition that is followed by a solid earnings growth. So since 2022, the company has been showing very strong earnings per share growth that is being also followed by, of course, the 7 to 8% dividend increase year after year. So the dividend triangle is telling me the company is healthy, the company is moving forward, and of course it is serving on a lot of tailwind. Well, this is what exactly my analysis of the business model was telling me, so everything works well. Now the second step is that dividend going to continue to increase high single digit going forward? Well, if I look at the payout ratio, so I've looked at the payout ratio and also the cash payout ratio, because it's important to just not look at the accounting side of things, but also the cash flow payout ratio. Both of them are way below 50%, telling me that there's a solid trend again happening that has been, of course, in line with how the earnings per share has increased over the past 3 years, while it's being reflected on the dividend, even if it continues to increase. So again, I'm well comfortable having a company with a strong dividend triangle, low payout ratio. The next step is to look at how this company is managing its cash flow. It's always great to find businesses that grows by acquisition, but then you don't want this company to fall into gluttony, buying way too much, getting too much into debt, and then struggling, right? So they have made it quite clear that their priority is to sustain their current capex, maintain a strong balance sheet, and then pay their base dividend. Once you have excess of cash flow, they offer shareholders more share buybacks, more dividend growth, and of course, those acquisitions. And when I looked at the debt level, I was super happy to find that the debt level remained relatively stable year over year, even when the company continues to grow. It tells me that the business is using its free cash flow, its excess of cash flow, to grow the company instead of borrowing more money every single year. Going into the final stage of my investment process, it's time to write down my investment thesis. I write down an investment thesis because it will be my reasons to buy the company, but also the reasons to sell. Every quarter moving forward, I will review Stantec, looking at the investment thesis I wrote and the numbers to ensure that the dividend triangle and all the other metrics are backing the reason why I bought the stock in the first place. If it's not the case, I will be patient. I can wait for a few quarters, especially for a company like Stantec, because it is a cyclical business. I can wait maybe 2 years, but if the company is not able to shift things back to a strong dividend triangle, well, therefore, it's going to tell me that my investment is wrong, and then I will have to sell and move on. But for now, what I wanted is a play on infrastructure. So managing aging structure, making a play on climate change, and also offering water services. Another thing that I like about Stantec is its ability to grow through organic growth by cross-selling, by also surfing on important tailwinds, but also growing by acquisition. They also have a wide offer, enabling them to play on different types of field depending on the demand and depending on the market. That should also reduce the volatility and the cyclicality of its business model. They show a very strong backlog and a long-term relationship with their client, proving that they have a sticky business model with predictable cash flow that will lead to more dividend growth. So I'm curious about what you think about Stantec. I will see you in the comment. Let me know if you own that stock or if you own this competitor, WSP Global. We're going to continue over there. And in the meantime, don't forget to give me a thumbs up, subscribe to the channel to not miss my next video on next Thursday. And until then, don't forget to stay invested.